please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We've got Pranjul Bhandari joining in. She's Chief India Economist at HSBC. Pranjul, thanks very much. Good to have you here as always. Two questions. One, can we now say clearly, without any doubt, that the market, the rupee market, is disappointed with what was announced over the weekend, looking at the reaction? And two, are you surprised that the RBI is not in the market already, intervening with some heft? Because, a sharp slide like this, right after announcements over the weekend, what kind of signal does that send?
Well, look, I think the weakness today is not just India specific. It's across currencies. So I wouldn't put it on what was announced on Friday night. And I think it's also important to put what was announced on Friday in context. I think it was a good first steps in the sense that it gave a signal to the market that the government and the RBI are together, looking at all of this and taking coordinated decisions on many fronts. I think that was a signal that the markets wanted from macro leadership. The second thing was that it gave a good signal that India is open to foreign investment. It wants to keep the macro house in order, meet its fiscal target and so on, and that there is more to come. This is just a start. So on all these fronts, I think it was decent. But it's not enough at this point because the entire global economy, global external factors are not stacked in India's favor. The Fed is on a hiking spree, USD strength is continuing, risks of EM contagion from other countries is fairly widespread, and the rupee is not being seen as undervalued as yet. So on all these fronts, the odds are stacked against India for right now. And therefore, it's very difficult to see a turnaround very quickly.
To the other question, Pranjul, are you surprised that the RBI is not in the market heavily? I mean, just the optics of it.
Well, yeah. Well, so two things that the RBI can do. Number one is raise the repo rate, and I really didn't see any reason for a pre-policy rate hike. So we haven't seen the end of that. We have a policy meeting coming up. And the other is FX intervention. They did intervene heavily for a long time. Right now, they've softened their stance because they also need to make sure that they have enough foreign exchange reserves in their arsenal. They can't keep frittering away, $5 to $6 billion every month. So they have their own math. We have many more months to go right now. So they're sort of, keeping it under check, and it's fine. It's the policy that they have at this point. Also, if it's a against EM sort of thing and it's not just against India, then perhaps the better strategy is to wait and watch.
Okay. Pranjul, what's your expectation in October as well as from in December from the RBI?
Well, we're expecting 50 basis points in rate hikes in fourth quarter, so split between October and December. But just trying to explain why we're expecting that. The root of the problem right now is a widening current account deficit, which is not finding external funding. And what we find when you look at this carefully is that the widening of the deficit has been both led by cyclical and structural reasons. Cyclical is the fact that India's growth right now is running higher than global growth. The growth differential is only rising, and when that happens, then imports run faster than exports, and the current account deficit actually widens. And the traditional measure to fight that always has been rate hikes, and we just can't run away from it, and therefore we expect 2 rate hikes in the fourth quarter. We also see another reason for the widening of the CAD as structural, the fact that over 5-6 years our exports have been weakening, and the fact that consumer preferences in India have changed. People now want to buy more smartphones, and these are structural changes. That's going to continue over the next couple of years. We need to address these as well. I think for the former, the best thing you can do is come up with a very granular export master plan. It won't have instantaneous rewards, but we just can't run away from it anymore. We really need to work hard to revive our exports.
Okay.
So I think a combination of these 2 rate hikes and export revival will be the way to go.
Okay. Pranjul, I just wanted to actually dwell a little further on the export point, because if you just look at our trends in the past couple of months, the maximum we've spiked up to in terms of exports has been, say, around $29 billion. In your sense, factoring in this new bout of rupee depreciation that we've seen, how much do you think our exports can probably spike up to and sustain?
Well, interesting question. Now, last year, exports in India fell by 0.6% of GDP, and that's core exports, non-oil. I think a part of it was also problems on the back of demonetization and GST. So once that corrects, and we're actually seeing quite a lot of correction in that, then goods exports could improve a little bit this year. In terms of rupee depreciation, we find that the impact of rupee depreciation is far greater for services than for goods imports, and we're actually for exports, and we're actually seeing that. So I think a combination of goods exports rising a little bit because the GST problems are ironed out, and services exports rising a little bit because the rupee is now depreciating in a healthy fashion. I think both of these will result in some kind of export improvement. But the problem right now is that this may not be enough because imports are rising at a very, very fast clip. It's not just oil exports, it's also core imports, all the electronics that we talk about. So the current account deficit right now is on a widening drag. There's a one interesting point that, the CAD is widening, but the first derivative of the CAD, which is like the change in CAD, is actually falling. So there is that faint silver lining that in the first derivative, the CAD is not widening as much as it was widening last year, and that's because exports are picking up a little bit. But nobody cares about the first derivative at a time when the dollar number that needs to be funding is so high and external funding conditions are tight. So it is going to be something that's going to be stacked against India over the next couple of quarters.
Mm-hmm. Pranjul, so these measures which were announced, the one criticism is that these are all measures which work when your currency is actually strong and prospects of it for rising are more. I mean, for example, masala bonds, right? I mean, who's taking the risk? The forex risk. Foreigners are. Now, would they want to put money in at this time, at a time like this? And what do you make of this 8 to 10 billion inflow number, this estimate? Have you done some work, try to see where this number is coming from? And second, have these moves and not more, in a way, emboldened speculators? Because, or you think that 72, 91, those kind of levels, we've kind of sort of made a top and that's it. What's your view?
Well, yeah, so see, lots of questions there. I agree with you that this is just a start. It is not a step that would have completely changed the sentiments around the rupee. And of course, a lot of other things have to go right for that. For instance, foreign investors need to be interested in India in the first case in order to bring in money, to make most of these masala bond removal of impediments and so on. And that's not the case right now. So I completely agree with you that that was not the right strategy if you think about short-term, short-term stabilization in the rupee. But I think the greater part of Friday's announcement was that that there is some macro leadership in the sense that the government and the RBI are talking together, looking at the rupee, and are ready to come out with a battery of things if they feel that the rupee is going out of control. The other thing that came out very strongly was the fact that there is more to come. In fact, just this week, they might be announcing a lot of things on exports and imports. So, I won't criticize it too much as yet. Let's wait for a little bit more time and see what is the entire package, before we take a final call on how good or how bad it is.
Okay. Pranjul, just a two-part question. What are your expectations in terms of, say, the export boost that could come through in terms of government measures? And secondly, what are the levels that you are tracking on the rupee in terms of, say, depreciating to that particular level and even pulling back? What is the range and what is the target?
Well, our FX strategists, they're calling for 73 by the end of the year and 74 by the middle of next year for now. So that is our view on the rupee. On exports, we've done a lot of work on this in the past, and we find that looking at goods and services exports together, what really matters is domestic bottlenecks. About 50% of the slowdown that we've seen in the last couple of years can be explained by domestic bottlenecks and impediments getting even worse with time. Global growth is the other factor. We find that a third of the weakness we saw in exports was because the global growth environment was weak in the last 5 to 10 years. And the third is the FX. It only explains the remainder, which is about 20% of India's export performance. So while it matters, it's not the main thing. If we do see an exports master plan coming out, we would like to see it being focused quite a lot on bottlenecks and a very sector-by-sector approach, that what really is the problem that exporters of each sector face. I think that's the only thing that would be credible at this point.